Just wanted to start by welcoming you all here. Thank you for coming. I know most of you out there, but not everyone, so I'll quickly introduce myself. I'm Ryan McGlone with Cascade, Hasson, Sotheby's. Oh, thank you. Out of the Bend office over there in the Old Mill, and I run a small team there, real estate brokers, which it's all part of the McGlone Property Group. And I'm very excited tonight to have two outstanding participants and guest speakers joining me tonight to share their insights on a little bit of what's going on in the economy right now, because there's been a lot of change and it's been happening rather quickly over the last couple of months, as well as some insights into what's going on here in the housing market. Before I jump into introducing the guest speakers, I did want to quickly thank Jana Wilcox in back here. Jana is another Sotheby's broker, and she has been working, we've been working together for probably the last year and a half or so. And if you haven't had a chance to meet her, she is an absolutely incredible human being. So make sure to say hi, introduce yourself, or introduce yourself to her maybe before you leave today. So she's been an integral part of our team in the past year, and very happy to have her here tonight. Also wanted to thank Broken Top Bottle Shop. We've done one event like this in the past. I think it was maybe about 8 or 9 months, I think before, well, maybe a year before COVID started, with the intention of doing more of them, but after that started, we weren't really able to do much. So they let us use the space to host these events, and we're hoping to do more of them in the future. This particular event came about, I reached out to Damon Runberg when we were talking about some stuff, maybe about it must have been like 6 or 8 weeks ago, and talked about how we needed to do an event like this again, just to capitalize on the opportunity to share what's going on out there. And so these two great folks volunteered to step up and help. They didn't get a whole lot of notice to plan this event, so you know, I do want to thank you both for jumping on it pretty quickly. We're going to kick off with Damon Runberg, who is the chief economist with Business Oregon. And for those of you who haven't seen Damon speak before, he's done quite a few events here in Central Oregon. He, in his past life, was also a labor economist focused on Central Oregon as well. And so he's going to give us a little bit of an overview on what's going on in the economy. And then we're going to jump in and have Donnie Montagner present next. Donnie is essentially a fixture in the real estate industry here in Bend. He owns Beacon Appraisal Group, and he publishes a very highly respected report every month called the Beacon Report, which covers most of the real estate and housing demographics here in Central Oregon, not just for Bend, but for surrounding communities. So highly respected report, does a lot of great in-depth analysis on what's going on in our market. So I'm very excited to have him present. And then I'll just kind of be following up to try to tie it all together a little bit in terms of what is going on immediately right now in the market, and how are some of these economic trends impacting buyers and sellers in real life as we see things playing out today. So that's the plan. And then after that, we'll kind of jump into some Q&A so that you can all, if you have any questions that come up, feel free to ask us questions, and we'll do our best to answer them. If not, we'll be taking some notes, and we'll follow up with answers when we can. So I am going to turn it over to Damon. Here's the clicker.
Oh man, look at that.
Here's the mic. Have a seat and take it away, or stand,
Awesome.
whatever you want.
Yeah, I will. I'll stand. Is that okay? Hey, good to see everyone today, this evening. I don't often talk at night. I made a special exception for Ryan because he's a friend, but normally I do morning events, so I try to keep me awake here, okay? So, yeah, I'm with Business Oregon. I'm their chief economist. The new joke that I found, I've been in the job for like 3 weeks now, or 4 weeks. I'm the chief economist, but the only economist they have on staff. So I've kind of like, it kind of feels like a backhanded compliment to like call me the chief of it, but hey, I'll take it, and it was a pay raise. So yes, I have been in Central Oregon for a dozen years, and many of you have probably seen me speak in my other hat when I was the regional economist for Central Oregon, but I've changed to sort of a larger scope looking at the state as a whole. And, you know, as an economist, the one question that you always get is, are we in a recession? Or, if it's clearly that we're not in a recession, it's, when is the next recession going to happen, right? Those are always big ones. Now, In the last few months, these conversations and these questions have gotten like really intense. We've been seeing a lot more excitement and projections and forecasts for late 2022 or early 2023 recessions. And that seems like a crazy conversation to have because we're also seeing on the news every day about how we still have a tight labor market and it's hard for businesses to find workers. And you very rarely would ever hear someone have concerns about a recession in the midst of a time where it's hard to find workers, right? So there are some confusing mixed messages that we're seeing happening right now, which gets me to, I don't know if any of you are Willy Wonka fans, and it sort of feels fitting for the fact that, we're on the edge of Halloween here, and the one real creepy scene in that movie when they're on the boat, we all know the boat scene, right? But I love the part where it's like, no speck of light is showing, so the danger must be growing, and they're certainly not showing any signs that they are slowing. There's some mystery and some air, but we have no idea what the hell he's talking about, right? Like, he's just sort of rambling and saying scary words, and we don't know what direction the thing is supposed to be going that's scaring us in the first place. We just see, bats and spiders on the wall or whatever it is in that creepy scene. So this quote has made me think a lot about what people think about the economy these days, which is confusion and this fear, but they're not really sure what they're afraid of. Okay, and so we'll talk a little bit and see if we should be afraid of anything that's happening right now or not. I'll lean on these. I'm getting a little teaser here. Probably shouldn't be too worried right now. So why are people fearful? One of the big things we're seeing today, why there's a lot of talk about uncertainty in the economy today, has a lot to do with inflation. And for many of the people in this room, I'm just doing a quick demographic check here. Most of us have never experienced inflation that looks anything like what we're seeing right now. We've been seeing annualized inflation at roughly like 8.5% the last few months. That is a high level of inflation. You have to go back about 30 years since we've seen anything like that. And you can see it's not unprecedented. We had periods in the early 80s, late 70s, periods in the early 50s as well, sort of in the post-World War II era, where we had high rates of inflation like this. But for the modern economy, this is really abnormal for us to experience. And as someone who's, a geriatric millennial, we've never seen anything like this. So that's a real thing, by the way. Also, just I like to remind audiences all the time that millennials turned 41 this year. So remember, stop calling them kids. They are grown men and women. It happened. So you look at this, and this looks really terrifying, though, right? At the tail of the graph here, like everything's still really vertical. Like this doesn't look good. Nothing's coming down. But I'll give you a little teaser here. If you like zoom in really close, if this was a phone and you're doing this thing, you would see an itty bitty turn down right there, and then you can see the pace on the actual index line itself, the blue line there for the CPI. It looks like it's starting to turn from accelerating to decelerating. Now, this is really early in this trend line for us to be real confident about the direction that we're seeing here, but I am very confident that we have probably seen, maybe, that's how confident I am, peak inflation. I think we're starting the deceleration phase as we speak right now, and there's a few reasons why. So we'll get into the 3 reasons why inflation is probably decelerating, maybe not down to 2% inflation that we were accustomed to before the pandemic, but it is going down. So there are 4 major components that the Bureau of Economic Analysis, the Bureau of Labor Statistics, the BLS, uses when they're looking at inflation. They look at all sorts of components and prices, but the 4 big chunks we think of are food, energy, goods, and services. Okay, that's our lives. Down to what we spend, it sucks. So, I think more exciting categories, wouldn't it? Beer, hopefully, should be on there too. Sorry, I didn't mean to do that. Usually you might hear the term core inflation. Anyone heard that before? Oftentimes that's like all of the inflation, all the goods and services pricing, but they take out food and energy because it's so volatile. Okay, and you can see here how volatile energy is. This is just the month-over-month changes going back to March of this year. Crazy. So we all remember this last spring, besides the snow, we were also experiencing really high gas prices. By the way, it's been really high again, but that's for a different reason. But you can see the huge markups we saw in inflation and energy. But the last 3 or 4 months, really positive downward trends when it comes to energy pricing. So that's one of the big reasons why we should be pretty confident, because energy is a big factor in the other cost components that we experience in the CPI. In particular, food as well as goods are very much tied in with energy prices because we have to transport goods and foods to market. And so with lower gas prices, it also leads to lower food prices, et cetera. So we know that's going to start to pass through in the inflation indicators. The one that we really need to pay attention to that's really problematic right now is services, and it looks very not scary because it's the yellow bar here. But services represents roughly 56% of all of our spending. So all these other things can fluctuate quite a bit, but knowing that the vast majority of our spending is in services, we haven't yet seen that start to turn a corner yet, and it's still accelerating. So my optimism is rooted in the fact that energy prices are going down relatively quickly, and we'll start to see some things be more cost effective or a deceleration in prices. But I'm still a little nervous about the services thing. But you'll see in a second here, I do have optimism that services long term will start to decelerate too. Actually, you'll see right here why. So wages, so what we're looking at here is over the year change in Oregon wages, going back pretty far. We're going back to the beginning of the 2000s here. The blue line is the nominal wage gains over that year-over-year wage gains. And the orange is inflation-adjusted, real wage gains. And normally I wouldn't put both on the same graph together because they, as you can see, generally move together. But it's really important for us in a time where we're talking about inflation to sort of understand what's happening in a nominal sense versus what's happening in an inflation-adjusted real sense. And you can see before the pandemic, I mean, there's a lot of volatility what happens in Oregonians' wages throughout time, but we tend to see that nominal wages are somewhere between 2 to 4% is pretty normal in a year to see on aggregate Oregonians' wages going up by that much. Inflation was running before the pandemic on average between 1 to 3%, depending on the year. So that sort of cuts that in half, if you will. And so real wage gains, normal real wage gains were between 1 to 3% is what you'd expect. The blue bar or the orange bars here. A couple times it dipped into the negatives, but not a ton. So we get to the pandemic and crazy things happen, okay? This first spike you see in wages right here is actually what we would call a composition issue. What happened there was we had a bunch of people get laid off in the pandemic. Here in Deschutes County, 20% of our workforce got laid off in 1 month. 1 month, insane. Who are the people that got laid off? You remember? Service workers. And guess what? They tend to be on average the lowest wage workers in our economy. And the way that averages work is you cut out the lowest wage workers, it makes the average skyrocket. So this spike is actually like fake. This is because people lost jobs, the average wage went up. So that's a composition issue. Let's ignore that from like an economic principle perspective. The second spike though, this is the rehire phase. If we were going to rehire a bunch of low wage workers back into the economy once the shutdown ended, what would we think mathematically would happen to the average? It would drop. It did not. It skyrocketed after that. That's how tight the labor market was, and the demand for workers was that even with those lower wage workers coming back in, they were receiving such large wage gains when they were coming back in the economy that it still resulted in really massive nominal wage gains. I mean, we're talking 12, 13% year over year gains in the average wage for Oregonians. Unprecedented. We've never seen anything like that before. So unprecedented in some ways is a good thing. That really helped to fuel, though, the extra cash people had in their pocket. People had extra cash in their pocket because the government gave them free money. People had extra cash in their pocket because they weren't spending money during the pandemic because it was hard to spend your money. People were making more in wages. All that fueled just cash that people then were ready to spend in lots of different ways, which fueled inflation. The good news in this graph, the reason why I feel really confident is one of the biggest fears we see in an inflationary cycle is this thing called the wage price spiral. And it's this idea that as we, as workers in the economy, start feeling inflation, we go to our employer and say, especially if it's a tight labor market, say, man, it's really expensive to get groceries. My beer was like 20 cents more than normal. Like, I can't afford this anymore. Give me a wage raise or I'm leaving. I'm going somewhere else. And they're like, I'm not going to find anyone else because it's a tight labor market, so I'm going to give you the higher wages. They do, but they have to pass that labor cost on somewhere, so they pass that on to consumers through higher goods and service pricing. And then we receive higher goods and service prices because you asked for a raise. And then guess what happens? I go back to my employer and say, now I need a raise because inflation is killing me right now. And this spiral just keeps happening, right? It just keeps going down the path. That's a bad thing. We don't want to see that spiral happen. And actually exiting that spiral, there's no good research on how to do that. It seems like we did exit it, though, and maybe someone down the road, years from now, will figure out how we exit it. But you can see we've seen a rapid reduction in wage growth over the last few quarters like rapid declines. We're down, this is just through the second quarter of 2022. So through June, nominal wage gains were only up about 4.7%, pretty consistent with the high end of normal, okay? That you could see going back in the time series there, and I'm pretty confident when we get the third quarter data, it's going to be down in like maybe the 2-3% on a nominal perspective. So very normal. The problem is you adjust that for inflation, real wages for Oregonians has dropped 3.6% in the last year. So like our actual disposable income is significantly less for workers out there because of these wage losses. But this is a good thing, because the wage price spiral is not happening. And that means all of us are going to stop spending money to the level that we were before. And that gets to the last reason why I'm pretty confident that inflation is going to start moving down. And that is the amount of disposable income that's in the economy right now nationally. And you can see on a year-over-year perspective, this huge spike we see in disposable income is all sorts of things. That's the people not spending money during the pandemic. That's the free money. That's the increased wages. But you look what inflation has done and the real wage losses. We get to a point now where disposable income is dropping significantly across the United States. Us having less disposable income in our pockets means that fewer of us are buying the beer, which if fewer of us are buying the beer and racing to get that one really good one, that means there's more beer available for everyone else, which means the prices of that beer is going to go down, or maybe not go up as fast as it was before. Got to remember, deflation is rare. We just see less inflation is usually the way it goes. So the prices of the beer is probably pretty sticky in that case. But so the three big reasons why I'm pretty confident inflation is in moving in the right direction. We've probably peaked at this point. You all feel good about that, right? You probably shouldn't though, because it doesn't feel good to know that like all of us making less money is a reason why we're going to see inflation improve. But at the end of the day, from an aggregate macro perspective, that is one of the things we need to see happening. That's one of the goals of the Federal Reserve right now. So this is that idea here where it's a good thing on the aggregate, but at the individual level, it's painful. And in some instances, really painful depending on what your household composition looks like, right? Another thing that we're seeing across, the economy is you tend to think, okay, less disposable income, people are seeing real wage losses, they're starting to cut back on spending. If you start cutting back on spending, that means that the people who make those goods or create those services are going to have to start cutting back on jobs too. Fewer and fewer people buying the beer means we don't need to make as much beer as well. And yet, when we look across the state of Oregon at employment levels, we see that we have recovered completely from the pandemic shock, and employment has stalled out. It's not going down yet. So we have record high employment in Oregon, no signs of any significant layoffs yet we're seeing this optimistic trend in wages. Maybe a little bit of a Goldilocks zone right here. Now, don't hold your breath too long because we might see layoffs, who knows? But at this point, we haven't seen those yet while we're seeing positive movement in sort of things we would want to see for inflation to start flattening out. And when we actually start looking at some leading indicators, things that tell us about what might happen in the future of the labor market, job ads is the #1 indicator for future job movement, okay? A job ad today usually turns into a job that somebody fills 3 months from now that we're gonna count on a payroll. And when we're looking at job ads, you see it's peaked in Oregon and started to come down, so that's expected. We're not gonna be hiring at the rate we were a year ago or a few months ago. So that's coming down aggressively, yet we're still sitting with the level of hiring activity 33% higher than it was before the pandemic. So there's still really elevated hiring demand at a time where we would be expecting to see the labor market really slacken quickly, and it's not happening quickly. And once again, it might happen, we're just not moving that fast. I'm feeling pretty good about this number here. In fact, we could get down into this like 2018, 2019 level of hiring demand, and employers are gonna feel a lot better about themselves at that point too. That means it's gonna be easier to find workers at that point, less competition, et cetera. So it's gotta be a less tight labor market. You put all this together, though, and my favorite way to quantify what we see in the labor market, the relationship between the supply and demand, is looking at the number of unemployed workers that are out there in the economy as a share of the number of job ads. So if you're a hiring manager at a business right now, how many unemployed people on average can you expect to come apply for your job that you have? And there's some crazy stuff on here. Obviously, the pandemic looks phallic and weird, but ignore that. We're gonna have to like cut things out of graphs for explicit reasons in the future. But what we see is that where we're sitting today is essentially the tightest labor market we've ever seen in Oregon. There's 0.6 unemployed workers for every job ad that's out there. There's half of a person, or there's one part-time person available for every job ad that's out there. More jobs than people to fill them, still. at a time when we would expect to start seeing the labor market really slacken, it's still aggressively tight. And we have a lot of room for this to ease up before we're ever getting stressed out about the labor market moving to worrisome trends with large layoff events, and those workers who do get laid off not having job opportunities to go to. Because if a layoff, we just heard one for Sisters, right? Laird Superfoods is laying off their factory in Sisters. That sucks. A very unfortunate situation. Thankfully, there are job opportunities in Central Oregon for those workers to move into. So we still are in a situation where there's a demand for workers who might be losing jobs right now. I'm not going to talk on housing hardly at all because we got housing experts here. But from my perspective, the biggest and most concerning thing that we're seeing, so the Federal Reserve is increasing rates to kill demand. Killing demand is one of the ways, right, once again, to address inflation. So they're doing very aggressive things. And we'll hear more about what's going on with mortgage rates. But what I care about is what that means for affordability for Oregonians. And our friends over at the Office of Economic Analysis, a peer of mine, Josh Lehner, produced this just last week looking at what affordability looks like in less than a year. Over the last 10 months, what share of households can afford the median house at the level of being right at cost burdened, housing cost burdened. And last year in December, 20% of Bend households can afford the median house with the income that they had. Fast forward to October with today's interest rates, it's down to only 8% of households in Bend could afford to buy the median home in Bend. Pretty nutty. And we've always been poor on this indicator, but you can see we've slid into new territory here. And we're not the only ones. This is a trend going on across the state, across the nation, and it has less to do with pricing in Bend or less to do with pricing in Oregon and more to do with the cost of borrowing and how that affects affordability. So don't read all this. I don't like putting words on slides. I just want you to know there's three big reasons why recession happens, typically. The three big ones are you see some sort of big economic shock. The pandemic is the best example we have of that. In fact, I used to talk about this before the pandemic and said, yeah, a shock could happen like a pandemic. Ha, ha, ha. And we'd laugh about it. And yeah, it happened. An economist could be right sometimes. But so we have big shocks that happen, unexpected events that come out of right field. A Y2K scare that leads to a dot-com bubble, and then we also have, a World Trade Center crash of planes that the world goes nuts, right? Things happen, wars happen, et cetera. We're not too worried about that, and if we can't worry about those things because we have no control or don't see those coming. Number two is a big policy error, like federal government policy error, legislative error that someone might make. The best example of that would be the price controls, the wage price controls we saw with the Nixon administration in the 70s. But you get down to the bottom one of the other big reasons why we see recessions is monetary policy with the Federal Reserve. And oftentimes in response to high inflation, they raise rates, and they raise rates and kill demand in the economy so sufficiently that it actually creates recession. That's the worry today. The recession that we're predicting, or people are predicting for this next year, is a monetary policy-driven one. The Fed might actually say, well, some of that goes back on the federal government because they're the ones that put fuel in the fire. But then I would say, well, you're the ones that also put fuel in the fire because you made borrowing 0% and also made it incredibly cheap to borrow. So everyone's to blame. Blame goes around to all. But it's probably got to be one of these two bottom bullet points are kind of got to be the reason if we do see another recession, what would drive that going forward. But overall, I would say I'm not too worried. There's a good chance we do have a minor recession, but the labor market is in such good shape right now that we can sort of eat some of those losses that might come from an employment perspective. And also, we have a lot of demographics moving positively in our direction. Baby boomers are retiring aggressively, leaving jobs behind. And so when you put sort of all those together, there might be a situation where we see a real recession with very little impact on the job front. And that's the best kind of recession to have. So if that doesn't make you smile, then I don't know what will. But thank you all for having me. And I think it's Donnie's turn now. So. You can't walk very far because that cord.
Oh, I'm restricted. Yeah. I am bound. I'm a walker too. Oh, shoot. Hi, I'm Donnie with Beacon Appraisal Group, and I'm glad to be here today or this evening. I was telling a couple people this is out of character for me because right about now I'd be getting ready for bed. So bear with me. I promise I won't fall asleep. I didn't fall asleep during yours. So I put together some housing trends just based on the Beacon report and some of the analysis that I've done over the years. This is my second business cycle, I would say. So Dana Bratton used to tell me you can get licensed, you can become an appraiser, but until you go through a business cycle or two, you're really not getting it. And so my first one was the 2004, 2005, that whole period. I just cut my teeth in appraisal industry in 2005 and rode that out, and then now we have COVID. And so these are some trends I wanted to share with you. Again, I produced a Beacon report. The hub is Bend. Bend's the biggest sample that I've got. Widely diverse with products, as I'll show you, and then Sisters, Lapine, Madras, Crook County, and so on and so forth. So we'll jump to it. I wanted to start off with the overall trend. This trend's back to 97. This is the Bend median home price since 1997. And you can see this pretty flat line, not flat line, but it's just modestly increasing. Up until what Damon pointed out in 2000, we got a little bit of a jump. If you zoom way in on this graph, what you'll notice is it takes about, I think on average, about 2 years to gain 50,000 median sales price. We accomplished that in 2000, and I think maybe the interest rates were lowered then. We had Y2K scare going on, and then it kind of moderated out, and then, of course, the boom in 2005. This data, there's a lot of data on this graph, and each one of these points is a data point, but these skinny lines, that's really intriguing to me because that's a huge jump in 1 month. And what I need to say about that, Jeremy Cowan used to do what was called the Bratton report. Dana gave me the report and it became the Beacon report. As soon as I posted it that month, Jeremy called me. You did something wrong. There's no way it could have increased that much. And me being me, I had to look at the data to see what exactly was happening there. And what I found is, we'll move on to this guy. I'm going to move forward. Can I go back too?
Yeah, you can go back.
Okay. I want to go right here. This is what I found. You know, the comparison of $1 million and over property sales in Bend just shot through the roof. And that had a consequence on the median home price at that point in time. So, for example, as you can read there, in 2019, there was only 13 sales of $1 million and over, single-family residential. I was going to ask what's that? Oh, single-family residential, yeah. And then in September 22, there was 38. Huge increase in the number of that upper-end market. Total sales in Bend in September were 182, and nearly 21% of them were $1 million and over. So just to give you some perspective there, let's see if we can get back there. Yeah, there we go. So in covering the markets, another trend that really caught my attention was coming out of 2005, or even going into 2005. We saw significant building in Lapine, Madras, Prineville, just huge expansion. I call that a migratory response to high prices in Bend, right? So people are pushed out to the outlying communities. That growth happened so rapidly, only in 2 years it excelled. It's just a tremendous growth. Now, if you take this bottom of the curve here, going into 2013, we start an upward trajectory again. A little steep in 2013, but we were playing catch up. You can see how the prices just plummeted after the recession. We stabilized in 2012 and then began to increase in 2013. The interesting thing about that was there was a mass migration back into Bend. Prices were way down. I mean, you were buying a property for way more reasonable than you could years preceding that. But this growth here, coming up to the pandemic, as steep as it is, it's pretty consistent. And when I think of like Madras area, Madras was slow in coming around. It wasn't like in 2004 where development was just taking off and houses were shooting up everywhere. It was really a slow process out in the outer communities. Sisters, on the other hand, is kind of an anomaly. Sisters is just a special place, and it's done very well for itself. The other thing that I noticed on the Beacon report when I was running that data was Sun River also followed the same suit as Bend. It happened later, but the $1 million and over sales in Sun River really shot that median sales price through the roof and just broke a record there. And that happened again and again, and not so much in Black Butte. But at any rate, so we got a pretty steady growth here, and if you put a best fit line on there, it's really in line. The only thing that jumps out is up here, right? So then we get to the pandemic, and I was asked early on that first quarter of 2020, what do you think is going to happen? And not being a pessimist, but I was hoping for a slowdown, some kind of temperance to the housing market, right? So less demand, increase in inventory, and stabilizing those prices to a modest gain. I should say back in the mid-1990s, I think on average I was seeing anywhere from a 5 to 9% appreciation in home values during that time period. So getting back to something more like that seemed reasonable to me. Well, quite, as you know, quite the opposite happened. Migration took place, apparently not as much as I anticipated, but our 2-month supply dwindled down to a quarter of a month. It just got chewed up. And so then we have the upper end market way outperforming what it's done in the past, jumping that median sales price up, and up we go. And now we're starting to see that turn. So I think what I'm optimistic about, and I just sold a rental property. And to give you an example, this rental property was in Redmond. Last year, I probably could have got around $380 for it. Okay, I put it on the market. I wasn't asking for a real high price. I thought it was reasonable, competing it to other listings. I ended up selling that at $355. Okay, so. But what drove that 380 back a year ago? Pent-up demand, a lot of demand, multiple offers, even escalation clauses or appraisal waivers, people having appraisal waivers. So a little out of the realm of consistency for that product over time. I feel good about the 355. So, but at any rate, so that's the overall graph. And then what I wanted to do is give you a comparison between 97 and 2000 to these last 3 years. So I'm taking 3-year snapshot, and I'm picking on September because that's the data that I had most recently. So back in 1997 to 2000, before the big boom of 2004 through 7, interest rates were hovering around 7 to 8%. Median sales price back then was $122,000 in Bend. Can you imagine that? So median sales price in 2000 was $170,000. So you start seeing that gain that last year. Average out between the 3 years is 13%. Now jump to 2019 to 22. We got interest rates ranging from 3.5% in 19 up to 6.7% September of 22. Median sales price is up 440, so on and so forth. And you can see 725 here this last month, nearly a 22% per month increase. My prediction, I don't have a crystal ball, but I think the contrast between even what we're seeing with the pandemic and what happened in 2005 through 2006, 2005 and 6 was policy issues. And through that, there was consequences that came with that. Lending fell flat. What we're seeing here, what I'm seeing is a lot more money on the table when a house is purchased. Okay, so a lot more secure in the sense of the bottom's not going to fall out of this. If I were a homeowner that paid in excess of a sales price or in a multiple bids situation, I might have a lower rate of increase that next year. That's going to have a consequence. But to have what we saw in 2011, that rental property that I was telling you about, that was purchased as a bank-owned. I didn't purchase. I was a second owner after the bank-owned. That sold for $65,000, right? It was renting for $750 a month, so it penciled right away. That's how bad the market was in 2011. I don't see anything aside from an economic or some kind of disaster that would plummet anything into a downward spiral for our housing. We're just a lot more secure, I believe. Getting into rentals just a little bit. So rentals, there used to be a survey done in Central Oregon for rental properties, and that's no longer in play anymore. So what I do is Mark, he's back there. He's a certified residential appraiser. We work on small income properties as appraisals. Well, you keep that data going, and through that, I can tell you our rental market seems to be pretty solid. My rental that I had, I chose to sell instead of rent it. But I could have easily rented it. New construction permits in Bend, so 2 to 4 family units this last year is actually outperforming what it did in 2020 and 2021. So far, year to date, there's 77 permits for 2 to 4 unit dwellings. So it's a pretty good indicator that there's some rental spots opening up there. From January through September 2021, there was only 27 permits and 58 in 20. And so compared to last year, I don't know what happened last year. It just dropped off. But compared to last year, we were 185% increase in those permits this year. So at any rate, that's pretty much what I have for the housing trends. How's that?
Awesome.
Kick it off to Ryan.
Yeah. Thank you, Donnie. All right, so I'm actually going to go back on one of Donnie's slides here. What I'm going to present on here is just trying to tie it in a little bit all together, and I'm really focusing on what exactly is going on here, and how is that impacting buyers and sellers in real time today, and what are we seeing out there? Let's kind of go forward here. So where exactly are we, and how did we get here? And this is just how it's specific to housing, not jumping into the economic stuff at all. The things that I wanted to really focus on, the 3 trends that I see that I think are very important to understand, is where the Bend median sales price is right now. I'm expecting that for the month of October, Bend's median sales price is going to come in at $682,000. And that is starkly different from where the peak was back in April, May at about $775,000. So quite a bit different than where we were earlier this year. The other component that I think is very important to touch on is where are current 30-year fixed rate mortgages. According to Freddie Mac and the report that they published with their weekly data at the beginning of this week, we were at about 6.94%, which is also starkly different than where we were at the beginning of the year, where interest rates for 30-year fixed rate mortgages were right around 3%. And the last number is looking at our months of inventory. So how fast are we moving through the velocity of homes that are out there on the market? And right now we're sitting on approximately 2.4 months of inventory. That also is dramatically different than where we were, and I believe Donnie and maybe Damon pointed out earlier, where we were at the beginning of this year, experiencing 20 days of inventory on the market. So how exactly did we get here? As Damon mentioned and Donnie alluded to, a lot of this is interest rate driven. So, roughly 70% of the homes that are sold in our market are sold with a mortgage, or non-cash purchases. And when we take a look at this little graph over here on the left-hand side, that red line is the monthly 30-year fixed rate mortgage trend by month for the last 2 years. The blue is the median sales price for a home in Bend. And as you can see, if we were able to zoom in on the slide, that first big upward tick is actually a rate surge that really happened at the end of Q1 into Q2 of this year, 2022. And you can see as rates surged over, I think, a 2 or 3 month period, upwards of 1.1 or 1.5%, we can also see that that's really, what really followed from there was the median sales actually flattening out and starting to decline a little bit. The second surge hit in Q3, starting in August, and that's actually run pretty much up until where we're at right now in October. And you can see once again where I'm thinking that October's median sales price is going to come in. We're starting to see the impacts of that rate surge. And what it really comes down to is the affordability and monthly payments that people are paying if they're purchasing a home here in Bend. The larger graph here, the red lines represent what that monthly payment would be if you were to have purchased a median priced home in Bend, assuming that you put 20% down at the current month, interest rate for that month. And if we were to take October, this last month as an example, even with prices starting to decline and we were to compare that to October year over year, your payment for this October is roughly 61% higher for the median sales price home, which represents about $1,340. So as you can see, prices are declining a little bit, but as I think Damon mentioned as well, a lot of that is really rate driven, and as we can see, it's obviously having a major impact on affordability for a home in Bend. Now, the interesting thing is that rates aren't only impacting buyers, they are heavily impacting sellers at the same time. And this is a trend that we're actually not just seeing in Bend, but it's also a national trend right now. And what we are seeing, and you can kind of see when you look at June right here, that graph right there, that's the number of new listings that hit the market each month for the past 2 years. Red is 2022, blue is 2021. And in June, we started to see the number of new listings year over year drop. And as we got into the later half of this year, when rates really started to pick up, the drops of new listings year over year were down roughly anywhere between 20 to 30% from July through September. So what did that do to our velocity, like our housing velocity and moving through inventories? It actually flattened it. So what you can see right here is that for the last 3 months, our months of inventory has been relatively flat at 2.4 months of supply. And it's that decrease in housing, new listings to market that actually right now is keeping the housing market relatively tight, and is why we aren't seeing home values falling even greater than they have already so far.
Right. Is that a locked-in effect? People worried about giving up a mortgage that's
it is
2.75%?
Yes, exactly. So I kind of have down here, for homeowners with a mortgage, higher rates equal less motivation to sell, right? So if someone was thinking about selling, maybe they're just going to move across town, or they're going to upgrade to a nicer home. They're taking a look at what that cost of borrowing is, and they're making the decision not to sell. Now, of course, we kind of have two different dynamics at play when it comes to housing supply in terms of the number of listings in any community. So some of that is a resale market, and then probably what a lot of you are thinking is, well, what about the new construction market? We have a lot of construction and a lot of building going on across Bend right now. Well, the reality is that the larger scale production builders in Bend did an excellent job forecasting these rate hikes and reacting to them earlier as they occurred, especially towards the back half of our spring. These are some of the larger housing developments here in Bend that really have the land inventories available to really increase the supply of housing on the market. And you can see in Petrosa, for example, there are about 675 home sites that are going to be built out. 130 so far have been built out over the last couple of years. There are only 9 active listings out there as of today, and I believe only 1 is completed. The rest of them are still in some sort of phase in construction. Polish has another huge community that's going to be coming on the southeast side of town called Easton. Easton's phase 1 release has been pushed back a couple times now, and they are supposed to be releasing homes in the next 4 to 6 weeks. Once again, the number of homes that they're going to release has also been scaled back as they're adjusting to the current slackening demand in our market. Stone Creek is another perfect example. This is D.R. Horton and Franklin Brothers, which is building a fairly large community just east of the old mill, right across from Highway 97. There's only 12 active listings on the market right now. So you can see that not only has the resale market really backed off in terms of adding listings to our inventory, but new construction has really pulled back. And like I said, that's something that we're actually seeing across the board and across the country right now. So I did want to jump into a little bit of national forecasts and give you some perspective as to what a lot of the larger financial institutions are forecasting is going to happen over the next year as we face down what is either going to be a soft landing or maybe a little bit more of a recession as we head into 2023. I think it's important to know that these forecasts are very, very dynamic and very, very tricky for anyone to put together. There are a lot of assumptions that are going into these. They're having to, forecast not only what is currently going on within our markets, but also how are policy decision makers gonna influence the decisions that are out there. So here are the 3 forecasts that I've been following. So Goldman Sachs, they're anticipating that nationally, the median sales price for homes will drop 5 to 10% from the peak of the market, which they see as this past June. So if we use Bend as an example, and we were to seasonally adjust, or roughly seasonally adjust, where prices were at the peak, our peak, which was more in April, May, we're probably already down 7 to 8% from that peak as it stands today. So we're kind of well on our way within that Goldman Sachs forecast. Wells Fargo, they're predicting that home prices across the country are going to drop by about 5% in 2023. And then the Case-Shiller Home Price Index, their revised numbers for October is that we will see about a 2% drop, or a 2% increase in home values in 2023. There are a couple common themes across these forecasts that I think are very important to follow. One is that it's an overall lack of single-family residence housing inventory that will play a factor in limiting the price, any further price declines. So that's something that we really got to pay attention to. And that there will be significantly fewer housing transactions in 2023. In fact, I read an article, I think it was the CEO of Zillow, who was almost anticipating that that we will see things kind of almost grind to a halt, just because what's unique about this scenario compared to past, the housing crisis we all remember, which is 2008, is that there is not an abundance of distressed inventory out there, and that people have a lot of equity in their homes, and instead of putting their homes up for sale or walking away from their homes, they're just going to ride out the storm until things change. And then the other thing that these forecasts comment on quite a bit as well is that even though interest rates seem really high right now, they may continue to rise even more from here into 2023 as the Fed continues to potentially raise short-term interest rates, and we might see some inflationary data over the next couple of months that comes out that's a little bit higher, which could then push mortgage-backed securities and 10-year treasuries yields up a little bit higher. So what are my takeaways for buyers? If I'm a buyer out there right now, what would I be looking at? I think the very important thing to really look at and understand, and Donnie's graph even kind of did a really good job of illustrating this, market dips are fairly rare. And we've seen a little bit of a dip right now. We're roughly, I'm roughly stating that, our median sales price in Bend might be down about 8%, depending on, what area in Bend you live in. And so there is opportunity to at least get that price at a lower, or get that home at a lower price. Inventory is still rather tight though. So if you're a buyer out there and you're expecting, deals to just come about you at leaps and bounds, they may not, because the fact is that inventory is still rather tight. Buyers now, compared to 6 months ago, they definitely have more time to go out and shop. And there is definitely more room to negotiate, especially for things like contingencies. But inventory is still rather limited. Buyers should also be exploring creative financing options. Obviously, the major thing that's driving homeowner affordability right now is interest rates. And there are programs out there that will allow people to lock in a lower interest rate right now, and then gradually work their way up over the course of 3 years to a more standard market rate. These are a little bit different than some of the loan products that you saw in the past, where you had variable rate mortgages. They can't just keep going up and up forever. They actually do cap out after 3 years. A lender also reminded me recently that VA loans are assumable. So if there are sellers out there that do have a low VA loan, they can actually, offer those up to buyers to assume those loans and potentially save some money on the side as well. The other thing for buyers right now, really stick to your budget and have a long-term plan for what you're doing. And I really think that long-term plan has to be a 5 to 10-year plan. If you're looking to purchase a home right now, you need to make sure that your budget is rock solid and you feel good about your numbers without relying on a refinance at the moment, and that you plan to be in that home for 5 to 10 years. As long as that's the case, keep an eye out for those refi opportunities, but I think it makes sense to buy home. Right now, I think if you're, obviously if you're a cash buyer, I think it's a great opportunity to take advantage of some of these home prices that are coming down a little bit. And I do think, if you are renting, it still makes sense right now to purchase a home. And I think that, taking control over your monthly expenditures when it comes to housing, and providing a little bit of more stability by getting out of the rental market is incredibly important. And the last thing that I think buyers really need to remember is that there's a lot more, many more benefits to home ownership, as a lot of you know, outside of just, hey, did I get a good value for my home? And a lot of that does come down on the rental side of not having to worry about being evicted from your home. Over the last 2 years, with housing prices rising as quickly as they have, we've seen a ton of people who have gotten evicted from their homes because they get sold out from underneath them. And then, of course, on the rental side of things, we have some rental protections in terms of in the state of Oregon in terms of how fast rents can rise. But as inflation has risen, that amount that that landlords can actually raise rents has increased quite a bit. So for 2023, a landlord can raise the rents over a 1-year period approximately 15%. So there's a lot of leverage for them to raise rents pretty high over the next year. From a seller perspective, what are the takeaways that I think are very important to remember? I put these two graphs up here because I think it's very important to notice, to recognize as a seller that yes, we are no longer at the top, but we're pretty darn close to the top. A lot of people that we talk to right now that are looking to sell often focus on that lower graph, which is where the median sales price or the average sales price has gone in the last 7 months. And they're not looking at the long-term picture, which is if you've owned a home for 2 years, 5 years, or 7 years, like you see in the graph up top there, you've actually gained a ton of appreciation in your property. And we are relatively close to the top when you look at that graph. Other things I would think about if I'm considering selling or exploring those options right now, especially if I was a second homeowner looking to potentially sell a second home, an investor, or someone looking to downsize, is what is the opportunity cost right now of protecting your gains? So as we do see the market flatten out a little bit, and we do know that home prices are up relatively high over the long term, is now the time to actually protect those gains, sell the property. Maybe you are going to pay a little bit of capital gains on an investment property, but you'll be able to roll that out into another investment. Even if you're an owner occupant and you've owned your home for 2 years, and let's say you're a married couple. You've got, you're going to walk away if you sell a home. You can take, $500,000 of capital gains as free and not have to pay taxes on it if you sell your home. And looking at that as an opportunity right now, I think is also very important. If you're someone who is thinking about selling a home and moving on to your next home, but higher rates were really impacting your decision, you should also be looking at those capital gains. And, if you sell that home today, you take that $500,000 as tax-free, you roll it over into your next home, and that capital gains clock starts over. You're essentially protecting your wealth over time. So I think there are some advantages there for sellers. 2 other things quickly that I would really focus on if I were selling is that in a shifting market like this, where there is a little bit more supply out there, marketing and making a great first impression on your property matters now more than ever. When things do slow down like this, buyers tend to be more picky, and some of those negative externalities on your home, they're going to be looked at a little bit more closely. So making sure that you're taking the time to really prep your home and get it ready is very, very important. Same with pricing. You really need to make sure that you price your home in the market. And when I talk about in the market, that means that it really needs to be in line with other competitively priced homes that are active on the market today. We've gotten a little bit sloppy with pricing, I feel like, over the last couple of years. You didn't really necessarily need to price in the market. You could choose to price your home under market value, and you would be rest assured that with competition that was out there, it would get bid up to where it technically should land. Or you could even overprice your home. And since the market was increasing at such a rapid rate over the course of a couple months, if you were a little bit high on your initial price, the market would catch up and it would sell. Right now, that's not really the case. If you're overpriced, the home is going to sit for quite a while. I also wanted to talk quickly just about how the current economic situation is impacting affordable housing in Bend. Damon touched on this a little bit. Obviously, when it comes to the single-family residence market and real estate sales, there's really no improvement in the near term, right? Not until we see rates come down will we really see that affordability improve. It's either going to have to be through rates, or it's going to have to be through large increases in supply that actually force prices down considerably. On the rental side, there's possibly some room where we might see rentals become a little bit more affordable. Kind of like Donnie mentioned, we've seen some of the permit increases occur over the last couple of years in the 2 to 4 unit market out there. The other thing that's a little bit interesting about the rental market is as the housing market itself has cooled off, there has been less of a demand for what I would call transitional rental housing. So if people are moving down from Seattle or up from California, they've sold their house down there and they needed a place here to stay for 6 months as they vigorously competed for multiple homes and lost out over and over and over again. There's not as much of a need for that right now. We're also not seeing as much of a need for that 1 to 3 month furnished executive rental market as well. And so some of the purchases, a lot of purchases were actually made over the last couple of years that were investor purchases really focused at those two demographics. And as those have slowed down, we are seeing a lot of those properties get converted to long-term rentals. And when you look at days on market for rentals on Zillow right now, it is increasing rather dramatically. The other thing that could possibly impact the rental market in the future is that the larger master plan communities that I talked about before that are being built by production builders right now, just due to land use changes and urban planning changes, both at the state level and at the city level, most of those communities now require developers to put in fairly large quantities of higher density housing. Usually it's in the form of rental housing. So if we were to take Petrosa, for example, Petrosa has about 200 units in a couple of different apartment buildings that are going in, and those are going to be actually opening up here soon for rent. So you will see these larger, higher density rental properties hit in the market over the next couple of years, and that could also soften rental demand a little bit. The one area that is, I think, very unique when it comes to affordable housing that Bend has been working on is the Stevens Road tract. For those of you that aren't familiar with it, this is a tract of land that was owned by the state of Oregon. That's just, really, it's just north of the Knott landfill, kind of right near 27th Street and just south of Reed Market. And there was some legislation passed within the state that allowed cities to potentially annex land into their urban growth boundaries without going through the formal urban growth boundary expansion application process if those lands were to be used for affordable housing. And in June, the Stevens Road tract concept plan was approved. And that plan is to annex in a fairly large piece of land that will provide just shy of 2,500 housing units into the Bend's UGB. 759 of those will be true affordable housing. And then a lot of those also will be smaller cottages, townhomes, et cetera. They're not going to be necessarily subsidized affordable housing, but they will be houses that technically can help out when it comes to housing demand. This is still a little ways out. Like I said, the initial plan was just approved. They're going to be working on amendments to the approved plan for the next 6 months, and then it's going to be on to the next phases. So a little bit of hope there on the affordable housing side, but in the immediate term, probably not a whole lot. And that's all we have. I think we kind of killed it on our time. We all were going to talk for 10 minutes each, and I'm pretty sure we just blew right past that. But we did want to open it up for questions. Feel free to we'll just kind of go around the room, and if you have questions, bring them our way. Anyone? Anyone?
I have a question for Damon.
Yeah.
All right.
So, Damon, you had mentioned that you're optimistic about the future of the services sector of core inflation. Right?
No, not yet. Well,
Yes or no? Not sure.
if you made me say yes or no, I'd say yes, long term. And the biggest piece of the reason why service inflation is rising was tied in with the wage prices, the labor costs that were going up. Since we've already started to see the tip over and the labor cost increases, I'm feeling pretty good that means that we're going to see a deceleration of service sector pricing. So I have a long-term optimism there for sure. But it's the one to pay attention to. So whenever you see the CPI report come out, the headline number is the one they're going to post, and they're going to hear the 8-point-whatever%. Sure, look at that. But zoom in on the services costs there, because that's the one that really we all eat as consumers, and it's the one that until that starts showing improvement, I'm not going to start feeling great about it.
Yeah, are you anticipating, so within that services portion of the inflation report, a good chunk of that is housing.
Yep.
mainly the rental part of the housing.
Yeah.
Do you anticipate the rest of the services, for this, the remaining 60% is going to offset the probably continued increase we'll see in the housing sector of that? Housing cost of that?
I mean, we'll see. It's so housing is roughly like 2/3 of that service component. It's a big chunk of it, which is also weird to think of services and housing tied in. The way they do it, I don't love.
Yeah, it's got a leg to it.
Yeah. So that's going to pass through here soon. We haven't seen it on the rental side yet, but nationally we've seen some slackening, and the indicators we're hearing here, feel pretty encouraged that we're going to see some easing. Once again, when we talk about easing of inflation, people immediately go to deflation in their brains. If we just see prices not rise any more from today, that means we're no longer seeing any inflation, right? But that doesn't mean we're seeing deflation. Prices aren't going down. There's not a situation where I see prices going down. It's a deceleration back to a more normal. I think 2023 will look like 3.5% inflation on an aggregate. So it's going to slow down to what feels a little bit more normal. But we're not going backwards, people, right? Like what you've been paying for milk is probably what you're going to be paying for milk, if not more next year too, right? And housing, we've seen it move backwards a little bit, but on the what you're actually paying out of your pocket, you look at those mortgages, you're like, we're still moving the wrong direction, right? Because now it costs more to borrow. So we're not really seeing benefit there. So don't think backwards in prices, just not going upwards as fast.
I know when you look at that in Bend, if I were to go back to that graph on just the Bend's median sales price versus where prices are coming in at versus what you're paying monthly, you actually do see that over the last couple of months it has flattened some. So even though rates are going up, you're seeing that being offset by housing prices coming down a little bit, and it is the acceleration is definitely much flatter, even though the rental increase or the rate increases are much higher over the last couple months than earlier in the year.
Sure.
Yeah. So thinking about like the Fed raising rates in November, December, thinking about lifetime, is there a timeline of when that shows up in the data? Does it take like 2 or 3 months, 6 months?
That's the question right there.
Yeah, when do you start to see
Yeah.
the effects?
I think they've gone too hot too fast. I agree. I think that we're going to see. The question is, when the Fed raises rates, when do we start to see the effect on inflation that we would hope, the positive effect that we would like to see from that? The answer is we see it. We see it pretty quick, but they panic with some of these lagging indicators that pop out. So inflation tells us something that happened in the past, right? And so we had a slowdown in inflation, but still was moving up. When the September number came out, they freaked out and they did another big rate hike. You look at some of these things, I'm pretty optimistic that, yeah, sure, it's not driving down, it's not nosediving, but we're moving in the right direction. So the aggressive rate hike again, was that justified? Probably not. I think that we need to see, I don't work for the Federal Reserve, so they didn't ask my opinion, but I think that the lag time between when the policy change happens and when the effect in the economy happens, ignore stock markets and such, right? That's a pretty long leg. I mean, at 3 to 4 months, 6 months, we might see those effects, and they're just not really giving enough time to see the effect of each of these rate hikes. So I'm hoping that they're much more conservative in the sort of the November, December window, and they don't freak out from whatever the October inflation number is. But it's working. What they want to do is working. Just give it a little time to work its way through. Yeah. We've now expired all my Fed knowledge.
Yeah, I would say a lot of those inflation numbers are driven by energy, and that's your classic up like a rocket, down like a feather.
Yep.
So that in and of itself is a lag.
Yep.
So what's driving the inflation is energy, which often has a lag when it comes to price correction.
Yeah, totally. Yeah, and ignore our gas prices the last month or so in the West Coast. So that a lot has to do with refineries in California. Actually, gas prices across the nation generally have not gone up at all, and we're still actually modestly declining. We're like the exception to the rule. So that our unique experience with gas in the last month is not going to show up in the CPI number.
I do have a question for Donnie. You shared some interesting information about how when certain things were happening in Bend, it impacted satellite communities. and how when Bend prices came back down after the recession, you saw more people coming into Bend and leaving those satellite communities. Are you seeing, as rates have increased over the last 7 or 8 months, have we seen that impact Redmond differently than it's impacting Bend right now, do you think, or any of those other satellite communities?
I think they're being they're all on the same playing field. I'm not seeing migration
Okay.
far. What was interesting about in the Beacon Report, which the Beacon Report's available on my website, it's free. You just subscribe to it and it'll come to you each month.
And it's awesome.
Is it?
It is.
Okay.
Yeah, it's great. Donnie's like a superhero here. He doesn't even know it.
I have all your email addresses, so I'll make sure to send out a link to it as well, so that you can subscribe to it.
So I did a trend line. I started breaking off conventional to cash transactions over time. And what was interesting to me was the parallel between, put a best fit line on there on each trend line. And Bend has got this just nice track all the way through it. Redmond's actually starting to spread, which I thought was interesting.
You're seeing more cash, or
no, less cash.
more finance?
Yeah, more finance in there. But as far as the migration goes with prices, we're a long ways off from where we were in 2011, right?
Okay. Yeah.
The prices in Bend were undervalued, in my opinion. We were down in the hole, and so people could afford to come back.
Yeah.
But yeah, not seeing the migration
Okay.
as impacted. But definitely a slowdown, longer marketing times. When I listed my property, I didn't have 15 people the first day wanting to buy it.
Yeah.
That was gone. And so, yeah, I think you were spot on saying, doll your house up. 2 years ago it wouldn't have mattered, but now it is. It's critical. You're selling.
Yep.
More or fewer cash buyers in Redmond to me would imply the reverse migration, where folks in Bend are perhaps moving to Redmond to find a housing they can afford.
That has gone on.
So
yeah.
it's kind of the reverse of what Ryan was
Yeah.
saying. Yeah.
That has gone on, but that's been going on for
Yeah.
some time, right? So, because the prices have been so high.
Yep.
I know of people that moved to look for houses in Redmond, couldn't find them, ended up in Culver, even up into Madras,
Yeah.
trying to buy their first house. So,
Anyone else? Come on. Don't be shy.
We're here until 11 p.m. So
I have a question just about Bend's home prices during recessions compared to the national average. I know during 2008 it dipped like about 20% more extreme than the national average. So I just wanted to know if you guys had any good information on kind of maybe do the same elements apply? Are things pretty different? Are buying demographics here now than they were back in 2008? And kind of are we anticipating anything different than what we're seeing in the national kind of expectations going forward in the 2 years?
yeah, I mean, I'll let these guys talk on the sort of what the buyers look like. Nationally, I mean, a lot of the policy changes that happened, the lending practices shifted a lot, and so the borrowers today are much more stable footing. I think Donnie had said something to that extent where, these folks are not sitting in a position where, we're going to see a lot of distressed homes hit the market really aggressively. So there's not a lot of stress from that, even if we start seeing some job losses tick up. I mean, we have to see some really aggressive job losses before we start worried about distressed homes flooding the market. And that's what really drove the prices down last time, was the sheer volume of short sales and foreclosures. But I mean, do you have anything to say about the solid footing of buyers today?
yeah, well, you are a lot solid.
You pat yourselves on the back. Is that
Yeah, very, very solid. That's an interesting point. During the last recession, I actually compared, I did an overlay graph of Bend and Portland. And Portland too had the spike in it, but Bend way higher than
Yeah,
Portland.
I did a graph with the national average and saw that there was a huge difference.
Yeah, there's a
in
big
pricing.
difference there. And I would say inventory is the same way. The rule of thumb, 6-month inventory for national average. I don't think Bend's at the 6-month level.
Yeah, we're
I
not even
think
close.
it's got to be lower than that. There's just an attraction to Bend that makes us kind of an anomaly market.
Yeah, and I was wondering if, before, if it was more just because Bend was more of a resort town back then, and there was less of the tech influence and all these other industries that are moving here with remote work and things like that to support a more substantial price that's sustained through harder times, and maybe not quite as much volatility. That's more where I was kind of wondering is maybe the dynamics that played back then maybe don't play quite out the same way now.
Same way now.
Yeah, I mean, I can tell you just from the volumes that we do, and who our clients are for the most part, that I do very little second home business at the moment. In fact, if I probably were to just ask everyone who bought a house or who moved here in the last 5 years, if you moved here in the last 5 years, raise your hand, you'd see a lot of hands go up. And
Trick question. No.
yeah, trick question. And so I think you're right. I mean, I think the demographics have definitely shifted. I think obviously that's what drove a lot of this, some of the outside of, cheap money to some degree, the growth that we've seen in the last, 5 years, especially the last 2 years. But yeah, I mean, when I think of second home, vacation home, kind of more speculative, investments, I don't see much of that at all. I was not in the business during the, living in Bend in the last recession, but I hear stories of it for sure, just about how much of that was speculative purchasing and second homes, vacation homes, stuff like that.
Makes sense.
And I think the 90s was a good testament of the economic base that was completely different than now. The old mill, the mill was still, Crown was still running in the old mill district. Benwood Products was right off the Century Drive. Now it's community restaurants, so manufacturing is completely different than in the 90s. And yeah, we're just, it's turned the corner. It's a new Bend, but it seems to me a lot more solid.
Are there a lot of remote workers buying? I mean, I know I'm one. Is that what you're saying?
Yeah, still, yeah. And I think, I mean, that's actually going to be a kind of a question for Damon too, kind of back to your old, maybe a little bit more in your old role, which is, it's always been kind of hard or difficult to track where wages are in Bend because of that. And are there ways to track that a little bit better and to kind of get an idea for what is our true median income when you take into account all of the different sources of income that are coming into Bend?
Yeah. So roughly what percentage of our workforce is work from home? Around 11, 12% before the pandemic. Now that's a lot higher now. We don't have updated stats yet because the Census Bureau hasn't updated them. It's also important to remember that work from home doesn't mean teleworking. Work from home is also like the person who has a home-based daycare service, like the one we used for our youngest for a while. So like there's a lot of people who work from home but aren't like working for a San Francisco tech company, right? So that not as sexy. It might be cleaning diapers, work from home, right? So that gets produced often. And people talk about like we have this huge share of workforce telecommuting. Like we don't actually know the telecommuting number. Probably with the pandemic, 10% would be my estimate roughly of workers telecommute today, which is. If you look at it, probably like the highest or like somewhere in the top 5 highest metro areas for telecommuting. So it is a big deal. It's a lot, but it's not like 30% or 40%. It's probably maybe 1 in 10 workers at most are doing that today. As far as incomes go, the data I showed showed that 8% of households could afford the median house today. That's a representative of household data, which captures workers who are teleworkers. Our income data gets skewed because it's where you're paid from, it's where your payroll's cut. So teleworkers throw off our average wage, but when we look at household incomes, it does capture those workers well. So that 8% is including all the folks who make high wages from other markets still, which is even more kind of doom and gloom when you think about it. But yeah, when you see the average wage stuff, oftentimes I talked about that as like, what is the average wage of the worker working in Bend? What could they afford? Which is an important statistic to talk about as well for the local wage earner. But that was one, there's a broader perspective there from the household side.
What is your thought on a lot of the articles that are out there that say that there are certain markets that are significantly overvalued because, like mountain towns in particular, right?
Boise, you're right.
Boise,
That's the one.
shining star,
It's really
right?
sexy to talk about
But
Boise.
Ben's on some of those lists, right? So, what is the premise is that they have a longer way to fall and will fall harder than the rest of the country longer term. What is in terms of housing prices? What's your take on that?
Me to take that.
The only I'll let them take their actual answer on that.
my perspective, I see all this crap on Twitter. Econ Twitter is a gold mine for valuable information and quality information, but you will, I'm not kidding, don't laugh, that's the truth. There are the doom articles from these housing contingent folks who like are every day telling you how the housing market's going to implode, and they've been saying it for like 15 years. So like eventually the person who cries wolf is right, but I don't believe him anymore, right? So some of those articles I'm always just like, yeah, I heard you say that 3 years ago too, and it's still, Boise's doing okay. You know, it's a beautiful community. If you want to live in Boise, it's fine. You've got to find a more affordable house, whatever. It just, sometimes those I feel like they're looking for some clicks on the which market's going to blow up next articles, right? But
yeah, I mean, I think even when you look at those national forecasts and read into those, a lot of them do, actually a lot of them will, it's not just mountain towns, a lot of them are focused on the West Coast, right? Because the West Coast has seen so much growth. And so I think there is some, you know, it's hard to say, but I do think there could be some legitimacy to that. I like to think, you know, depending on the mountain town you're comparing it to, you know, there are some things that I think make Bend unique geographically compared to a lot of those other mountain towns. You know, I know you and I have talked about this before. We're not a resort town, and we have pretty easy access to some larger markets from relatively quickly from Bend, and I think that does kind of help us, you know, potentially be a little bit more insulated than you know, if you're truly, you know, kind of much more remote mountain town. So.
And if you even look at some of those price projections that they have for the drops on some of these forecasts, you know, you look at the Boise number, which is one of the worst ones that you'll see. They're like, oh, it's going to drop like 22% or whatever, and you're like, that's still well above pre-pandemic pricing. So like, is that an implosion, or is that just the market going back to sort of market rate? It's probably that. So it's not the disaster that 2008 was, where we saw, you know, a 50% reduction in home valuation. You know, so anyway, I get really frustrated with some of those procrastinators. Yeah.
The more you click on them, the more they show up.
That's true. Stop clicking on them. The headlines are so good, though. I know.
Any other questions at all? I think we're kind of getting, I don't know what time it is, I haven't even checked. Bedtime?
Bedtime.
All right.
The hot takes will start getting hotter the more we stay. So.
We'll kind of wrap it up here. I wanted to thank you all for coming. Real quick before we kind of end it here, I did want to let you know that our team puts on a boot drive that benefits Family Access Network every year. And it's a winter boot drive where we go out and we essentially try to gather as many kids' winter boots that we can. And Family Access Network gets those boots and they donate them and give them to kids in our community that need access to warm feet over the winter. Obviously, you all know the temps changed rather quickly over the last couple days here, and we're kicking off our boot drive. I'll just call it right now. The technical kickoff for it will be this first Friday at the Art Walk. Our team will be down at the Sotheby's office down there off of Wall Street for First Friday. You can feel free to come by, hang out. We're going to have a couple raffle items for folks that come down and donate at that time. We're changing things up a little bit this year. In past, we've actually asked people to participate and actually go buy kids' winter boots or find lightly used boots and bring them. What we're going to do this time as well to make it a little easier is you can donate directly to Family Access Network. So if you want to donate $20 towards the cause or something like that, there's a link through these handy dandy QR codes that are now back in fashion again that we'll have up on the counter here. We'll probably send them out in a recap email for this event as well. And as long as you put MPG in the additional comments field, Family Access Network will coordinate with us to use that money to buy boots for kids in our community. It's a really, really cool organization. If you haven't looked at Family Access Network before, they provide a tremendous amount of support for lower income families and families that do need help, especially kids in our community. I'm a little biased. My wife is a school nurse over at Bear Creek Elementary, and each school has a fan advocate, so they actually have an advocate at their schools. And we, I hear about these requests all the time. It can be for jackets, it could be for housing supplies, all sorts of stuff. You would just be surprised. I know, a lot of us that are in this room are very fortunate with where we are and where we live in Bend, but there are a lot of families out there that are in need. So definitely check it out, and we'd love to help us support them. So thanks again, everybody, for coming. I'm going to try to put together another one of these coming up here in Q1. Right now, we're kind of toying with trying to get the city of Bend to come out and see if we can finagle them to give us a greater detailed presentation on that Stevenson Road project, as well as some information in regards to where the UGB housing inventories that are available to build on, where they're at with all of the land inventories that were annexed into the city this last go around when the UGB was expanded in 2016. I haven't gotten them to commit to that yet, but I'm pushing on them to do it. So we'll make sure to share that all with you as things develop from there. So, and thanks again, Donnie and Damon. I know it's getting late. You guys are both morning people. And yeah, I really appreciate, we all appreciate you showing up and helping us with this.
Thanks for putting it on, Ryan. Appreciate it.
Thanks,
Thanks for showing up.
Yeah, thanks everybody.